and Gary Smith, also with Mike's costs. I thought that was a particularly good graph. So we're the ones that have got to convince people to go out and buy dairy farms under these circumstances, and that's why I say it's not a tough gig. It is a very tough gig, I beg your pardon. I didn't prepare any slides, ladies and gentlemen, and I'd like to also endorse Gary Smith's remarks. It's a great show of physical strength here. A lot of dairy farmers, but there's also agricultural service people and others, agricultural suppliers, and I couldn't endorse Gary Smith's remarks more. The show of strength, not only here, but it needs to go on from this meeting onwards. Now, I was just asked to give us a brief snapshot of the real estate situation in dairy farms. Our company sell dairy farms from probably Winchelsea in the east through to the South Australian border. And at the moment, we've got around 40 dairy farms on our website, and that's a marked increase on what normally is there. And they're the ones that are on our website. I'm going out this week to show people farms that aren't on our website, for instance. So there's a vast array of farms out there to sell. Not only are there 40 farms on the website, a lot of those farms have been there for a long time, 12 months. Some have been out there for 2 years, and we don't often leave them there for 2 years or 12 months. It's a bit like putting a for sale sign up nowadays because they go stale. But there's a complete oversupply of farms on the market at the moment, and obviously the reason is quite simple. You've just heard it, and we're the ones that have to try and sell them, and that's our job, but it's a tough gig. In relation to some trends, the trends from, let's say, 2008 and 9, it was pictured by Mike's graph up there, back to 2012, probably with farms that are highly motivated to sell, and what I mean by that is that perhaps under financial stress, those farms in the last 3 years have fallen by probably 30 to 45%. That's a lot, and particularly when you come and talk to the bank managers about equity situation, when you wipe off 30 to 45% off your bottom line. Now, I might say they're financially stressed farms or highly motivated farms to sell. They're in a free fall, and it's pretty hard to get a gauge on it too, because, as I said before, there's 40 farms on our website. That's not including everyone else's farms. We're only one company, so there's a lot of farms out there to sell, but it depends. We're not quite sure where it's going to end, and the other gentleman here suggested that this year, where are we going in 2013. The better quality farms, perhaps the ones that are retiring over a period of time, or perhaps a better setup in some way, and not as financially stressed to sell, their decline has been much less, 8 to 15%. Is a general rule, talking to some of my industry colleagues and valuers to get this information. Give you a picture on the grazing job, and that's been mooted here tonight. Dairy farms are certainly in pain, but when you look at the grazing situation, they're not much better off when you look at prime lambs and you look at weaner sales this last week. But grazing is back about 20% and maybe up to 30%. So you can see that the dairy farms out to 45%, they're the ones that are hurting. And I guess I also take the point with the situation at the moment is that the entry level to get those young farmers into the into the situation, into the farming situation now. We talk about $2 and $3 million to be viable. Well, it's pretty hard to get those young people into the industry. They seem to do it perhaps better in New Zealand, where they're a bit more structured, perhaps, when I talk to my New Zealand clients, but that's another issue too. But that's a bit of a snapshot in relation to where we are in the dairy real estate business at the moment. Where it's going to go in 2013, it's when you listen to Gary and Mike, it's who'd buy one at the moment in some respects, and that's not the way we want to be. Anyway, thanks for your time, and 3 or 4 minutes. I hope I've given you a brief summary.
All right, thanks, Nick. And that hones in again about the young farmers. Like, they're the ones carrying the huge the debt level, and again, it's reflecting on them emotionally and financially. And once they go out of the industry, they won't come back in. So You need to protect the youth in the industry, and we need incentives for those young ones. Okay, we'd like to invite Barry and Neil from Rural Bank, Manager to come along. Thanks.
Thank you. Firstly, I just want to endorse a couple of the other comments. The turn up here, fantastic. This is a real show of emotion and commitment to the industry. So credit to the organisers. Typically coming last in having something to say, everybody's kind of stolen a lot of the thunder, and I think Mike might have been looking over my shoulder when I scribbled down some notes this afternoon. What I wanted to talk about was a couple of the points that have been made about the decline in property values and the impact that it has on equity and the way that it can tie the hands of the farmer in trying to negotiate their finances either with their existing financier or looking for someone else. We talked about the things that are impacting on that, including the high Aussie dollar, the current milk price, the reduced export activity with stock, oversupply of properties, as Nick's just touched on. All of those things are adding to the absence of buyer pressure, so that typically you go to an auction, there'll be a vendor bid and passed in with basically no genuine interest shown. So at the end of the day, property values just continue to cascade down and down, whether it's 30%, 40%, very hard to get a handle on. But at the end of the day, the dairy industry is a very highly geared industry. Banks tend to love it because it's a regular cash flow type of business. So the debt per acre is generally much higher than it is in other agri-business. So if people have borrowed at sort of 60-65% of their property when it was at its peak in 2007-8 or whenever it was, and the property values have fallen by perhaps 30-35%, there's plenty of people out there now that owe more than what the farm is worth. I get a regular stream of phone calls from people that are looking for another bank and they simply can't refinance because you get into the conversation and you find that they owe more than the farm is worth. The cash flow is negative and has been, and they'll have mounting creditors externally. They haven't been able to pay, so the suppliers have been wearing the pain, being stretched out further and further and further. There are no easy answers for people in that situation, and we've talked about that. Issues with mortgagee auctions have been happening more frequently now than I remember in any other time. A lot of them don't necessarily have the word mortgagee in the advertising, but their finance provider will have been the motivating force behind the sale, creating that highly motivated vendor that Nick talked about. And typically those farms can be depressed in the way they present because they haven't had the money invested in inputs. So it's a tired farm into a very soft market. It's a double negative. As Gary mentioned, interest rates are low. If interest rates were high, we would have probably what you would normally describe as the perfect storm. That all of these things have all conspired to occur at the same time to leave people with very little in the way of alternatives. From a banking point of view, most banks will be happy to fund a negative cash flow for a year or two, particularly where there's been a good relationship and good business performance in the past and there's an expectation that the wheel will turn and you can get back to a profitable business. But if there's an expectation of negative cash flow year upon year upon year, crikey, some tough decisions really need to be made. And that gets back to what Mike was showing in his representation, that increased income is really the only answer. Once the confidence starts to return and some buyer pressure can come back, Nick's going to have a bit more competition at the property sales. The values are going to lift. It's going to ease some of the pressure off the banks. But until that happens, the banks simply are not going to be falling over themselves to throw more money into the mix. So I hope that's a little bit of insight from where the bank's situation is. I am getting a steady stream of phone calls, and it may be an average of perhaps 3 every couple of months, so perhaps 18, maybe 20 a year of people that you just cannot help because their equity position. Mike was graphing, he's got his target equity position, but I'm talking to people with equities down at 10 and 15%, and that's on maybe some half-optimistic values. So a more pragmatic view might see these people basically being without anything. They may get the proceeds of a clearing sale and that'll be that. So thank you for your time. Appreciate the opportunity to come and talk and wish wish you well.